everyone, Diana here from Toronto Platinum Realty team. Thanks for joining us. Today on our very first podcast, I have Emma Michael from Aion Law Partners. And today we're going to talk about what are some ways to break into the market. And I think that's a really important topic to talk about in today's heated sellers market. So Emma, I'm going to give you a second to introduce yourself and we'll take it from there.
Yeah, thanks Diana. Thanks for having me. I'm Emma Michael and I'm a lawyer. I practice mainly real estate, but also in the areas of wills and estates and corporate law. So it's kind of what we focus on at Aion Law Partners.
Awesome. Okay, so you deal with a lot of buyers and sellers. We deal with the same type of clients. So let's talk about what are some of the issues, because the biggest problem right now is a lot of buyers feel really discouraged and really intimidated by the seller's market and they don't know how to break into it. But there are a lot of different creative ways that they can actually break into the market. So let's kind of touch on some of them. So that is one of the biggest problems. So what are some of the problems? Down payment, mortgage, heated demands, like, they can't put any conditions on any of the offers, and moving targets. So
yeah, I mean, I think everybody knows in this heated market, it's a moving target, right? Because the prices keep changing and our down payment requirements keep changing. And so people are struggling to make the amount they need for a down payment just to get their foot in the door and then take advantage of that market themselves. So one problem is definitely down payment. And then there is mortgage qualifications. Things keep changing in terms of the bank regulations and the requirements. So it's really important to understand that aspect of things because, there are different options available that a lot of people don't know about. So that's another difficulty. And of course, like the market is changing. And not only that, it demands a different level of preparation that people are not aware of or they're intimidated of doing, right? And so I think that those are the main things that prevent people. I mean, when you go into a deal and there's 40 other people that also want to buy that same property, you can't go in with conditions.
Yeah,
right?
Absolutely. What I always tell my buyers is if a house sells today for $600,000, honestly, next week it's going to be $630,000, and the next one it will be $650,000. It's always going up, so you can't expect to pay the same price. So you have to be prepared, and I think like you said, preparation is so important, because if you're prepared, then once you get into the market, you can move really fast. It's the people that are not really that prepared that are just kind of scrambling and getting really intimidated, and then they just give up.
Exactly. It is scary. It is scary sometimes if you're not prepared, you don't know, because you're putting this huge down payment on the line, and if you don't go through with your contract, you can't make it happen, you're losing it. And then you could also get sued. Like if the seller can't sell for as high of a price. So that's always a daunting thing.
Yeah.
But I love talking about this because I think that if we go through all the different options, not only you might be able to just find one that works for you, but you might find one, but you also might have one in your back pocket, right? So if something doesn't work in one way, then at least you'll know, okay, if my back is up against the wall, then I know that these are the other avenues that I can pursue to make the deal happen, right? And as long as you just know your numbers, then, it could be smooth sailing into an agreement, a purchase and sale, and buying a property. And then the great thing is, leveraging the movement of the market to kind of just build on your portfolio after that.
Yeah, for sure. So let's talk about that. So let's talk about the solutions. The first one is down payment. That's the biggest one because that's a lump sum of money. It's a lot of money for some of the properties in Toronto, right?
Yeah.
I always say you got to maybe look outside of Toronto or look at condos if you're just trying to get into the market, But I think that down payment is one of the bigghave problems for people. But there are solutions, right? Like there are lots of solutions. So let's talk about a few of them.
Well, I'll be honest. We have a lot of clients that are parents, a lot of clients that have families, and the reality is that there's a lot of intergenerational wealth that get passed on. And that's how a lot of people are breaking into the market.
Yeah.
So of course, if you are super focused and you can save your down payment, you should, and you should start young, and we should talk about that as well. But if you're not, just recognizing the fact that, help can be out there for some people. It's very
I think some people
often
feel really uncomfortable talking to their parents about that because it is a huge number. But here's the thing. Your parents probably bought the house. A lot of them maybe 20, 30, sometimes 50 years ago. They probably don't even have a mortgage. And why wouldn't they want to help their kids? So you refinance that house, such a low interest rate right now too. And by the time your house will build up equity in a couple of years, you take the equity out and pay your parents back, right?
Yeah.
If you really want.
Yeah. I mean, one thing is to know is that parents generally want to see their kids do well.
Yeah,
This is a
absolutely.
general statement, right? They generally do. And in that aspect, a lot of parents, though, they want their kids to do the work. So I totally get that, right? What you can do is tackle it like a business plan, right? And make a proposal to your parents or to your family members or to your uncle or to whoever, right? And they could maybe front you the down payment, gift you, I mean, there are some mortgage questions that have to be asked about where that down payment comes from. So that's important to know. But, it's so often
and that's
the case.
important to tell your mortgage broker, because that's going to come in as a form of a gift, and that has to be communicated.
Yeah.
But that's a different topic.
Exactly,
Yeah,
right? It's
yeah.
a different topic. Whether this family member or somebody close to you is just kind of lending you the money, or gifting it to you, that's another thing. But you can approach it from the lending perspective.
Yeah.
You lend me the money, and in a year from now, things will change. And, you have to put those things down in writing, right, on paper, and find different solutions to how to do
Yeah.
that. But it's very common. It's very common.
I have a question. Can you, because you do wills and estates, right?
Mm-hmm.
Can you add that in the will? Like that the parents have like a portion, maybe a percentage of the house.
It's totally
based
common.
on the
it's
down
totally
payment,
common.
right?
You know how many parents, and we talk about this all the time, because parents will lend kids, or they'll help one child over the other one. One is older, one gets married, the other ones don't. And there's a large portion of money that's gone from one to, from the parents to favor one or more than one child. And in the will, we always do this. We count for it. And we say, this is, I've helped this child more than
Yeah.
others. And so when it comes down to it, either, we won't take away from the property. We usually equalize it in the estate. So if something happens to the parents, then we'll just level it up with the other assets.
So there's a lot of options. So what's another way? Equity buildup. So we talked about that. Joint ventures. You do some joint ventures. Let's kind of discuss that a little bit.
Yeah. Okay. So so two different things, right? One is, asking somebody that cares about you for help. Okay.
Yeah.
The other thing is, you can convince somebody to go in on it as an investment with you. Maybe you will maintain the mortgage and somebody else fronts the down payment, and you have an agreement where, in a year, 2 years from now, or whatever the amount of time, you buy them out. Okay, that's another option. Joint ventures is mainly for real estate projects. So, you have an in on a kind of a dilapidated house or something that really could be fixed up, and you could profit from it either from a refinance after it's being fixed, or you could flip it. So usually it's usually joint ventures are for shorter term projects, so projects that have like a finite ending. Okay.
So builder projects, like development, like let's say you're building a property.
Renovating, flipping.
Yeah.
Even if you want to have an income producing property
I was
for
gonna say that, like a fourplex or something. Maybe
you could do
even,
that.
right?
You could do that. But usually there's a finite amount of time, because a joint venture is, you're venturing on a particular project.
Yeah.
But hey, it doesn't have to be a short period of time. It could also be a long period of time.
And
right?
those contracts can vary, right? Like there's not like a one type of joint contract, right? Joint venture contract. Yeah. There's different ways that you could kind of structure it that'll meet the needs of those specific people.
Yeah, it's mainly like we're going to do a business endeavor together, but we're not actually going to do a business together. You might have your business, I might have my business, or we might just be doing it in our own names, but we're going to venture together on a particular property for a particular purpose, right? And it might be a short-term thing for a flip, or it might be just, we're just going to go in on it as a rental income property. And the money generated is going to be split,
yeah.
right? And we're going to define those terms. We're not going to have a business together and share all those books and accounting, but we'll both profit from it.
And I've seen this so many times with so many of my clients. They get together with their friends or their cousins or family members, but as long as the contracts are well put together, then there's no confusion, and people make money and they can get into the market, and it's a really easy way to get into the market if you're struggling with the down payment.
I can tell you for sure that all of my real estate investor clients, joint ventures is a very common thing that's used to, acquire different types of properties.
Yeah, so 'cause I think when people think of joint ventures, they think of these like massive multifamily projects, and it doesn't have to be huge, right? It could be a very small project, but you could do it collectively.
The reality is that people do joint ventures all the time, and they just don't document them, right? And usually that's because they have knowledge of what they want to do. Maybe they're already in the property game. They have a really good relationship with whoever they're doing it with. But, you don't have to have all those things necessarily to find somebody to do a joint venture with.
Yeah.
Right? You just need to know that this is a possibility, how to plan, how to do a business plan surrounding the property that you want to get into and present it to people, right?
Yeah,
so.
Yeah, for sure. So I think this one is pretty obvious, but it's really just to have the discipline to save money. Now it goes back to the young people that are listening, right? Maybe in their 20s. And honestly, if I could have a conversation with my 20-year-old self, I would be giving myself this advice, right? It's really easy to kind of think that you have all this time in the world and you could save up money and you'll just come up with like $40,000 and you don't even think about how much home prices are going up and what you're going to be faced with when you're 30 years old. But honestly, the one advice I am going to give, 20-year-olds, 25-year-olds is have fun, but know your limits, right? Because you got to have some fun too. You got to have some experiences, but don't blow so much money. Save, save, save. This is a perfect opportunity. You don't have expenses. You're living at home. Typically you don't have a lot of expenses, right?
Yeah.
Generally.
Yeah.
Save. Have the discipline to save money. Work a second job. Have a side hustle, right?
Yeah.
We hear that so many times.
I mean, I don't think that kids these days get enough financial education in school. So one is discipline yourself to save 100%. And I think that parents need to do whatever they can to incentivize their kids to do that.
Yeah.
And hey, if you're a parent and you want to make a deal with your kid, something like that, like I'll match whatever you save, incentivize the people around you.
I know, yeah.
Right? And
Yeah.
but you also have to get familiar with different things available to you. So for example, if you're going to go to school, apply for every single bursary that you can. Apply for every single, take a part-time job. I worked through school and I still had a great time, right? So, I mean, like we've been working since I've been working since I was 13, and I still had a great time. So it's possible to have a job and to also go to school, that's one. And, get to know, also a really great tip is do an automatic savings plan. Right? So, I mean, the financial gurus of the world will say, automate your bank account so that there is a withdrawal from your account, your checking account to your savings account monthly. And just don't even think about it. Just do it, right? Yeah. And any extra money that you get, just put it into your savings. Now, the other thing is that there's other tools available. So, for example, there is this RRSP program. So the RRSP program, you can use $30,000 of RRSP. So you put money into your RSPs, right? And the great thing about putting money into your RSPs, if you're working, then it reduces, the amount of money that you put into your RSPs reduces the amount of income that the CRA, the tax authorities say that you made, which means that you get money back.
Yeah.
Right? So you'll get money back from taxes. So then not only are you putting money away in your RRSPs, but then you're also going to get extra money from taxes returned to you, right? Because your income is going down for the year, and that'll accelerate things, right? And then when you want to use your RRSPs, you have that first-time home buyer's ability to take out $30,000, no penalties and whatnot. And sure, you got to start paying it back. I think it's a year and a half after, but it's very small increments, and you just start a savings
plan. And it's
plan.
worth it. You're buying a house. Look how much how much they're appreciating, right?
Yeah.
And I highly, highly recommend for young people to follow. And I see a lot of that now, more so than I did in our days. Mm-hmm. They're following a lot of financial gurus, right? Like Robert Kiyosaki, Grant Cardone's. Like they're following these people and they're taking advice from these people. And I'm happy to see that because
100%.
A lot of people in our era didn't really do that, right? So it's nice to educate yourself, read books, don't rely on just school, right? Mm-hmm. Educate yourself, take the time, take weekends to do this, but definitely discipline yourself, save money, and always have a second job. You don't have to just rely on first jobs.
Yeah, discipline is a really big factor. And I think once you zero in on what your goal is and you really put your mind to it, then you can do it. And I think that's the main thing, right? Just determining that you can do it and then finding the tools you need to make it happen, right? And there's like you said, there's tons of people online on YouTube that are great to learn from. And I encourage all young people to do that.
And real estate investing from the beginning of time is a tried and true
Yeah.
way to build wealth, right? And I
Yeah.
read this thing the other day, generational wealth starts with one risk taker. So be that one risk taker.
The thing
you
about
know?
the thing about real estate, okay, I mean, we can't sit here and say that it's never going to fail us because, of course, things happen. All markets crash at some point, but
But
you know,
so does every other investment.
exactly. But the difference about real estate, which is why it helps in the acceleration of growth, financial growth, so fast, is that for every dollar that you put into real estate as your down payment, right, as your deposit, the bank is putting, maybe up to $9.50 more, right? And so, but then when the property goes up in value, let's just use the $10 example. If it's $10 and I put $1, let's say the bank gives me $9.
Yeah,
right?
you're making
90%
money
of that money is the bank's,
exactly.
but on the appreciation, so it goes up in value.
Yeah.
And 100% of that profit is mine. So I'm profiting off the bank's money, and I'm just going to give the bank back their $9,
Exactly.
and I'm going to make all the money on it. So I think that's what people need to really understand when it comes to real estate.
Yeah, because if you're buying stocks, you're putting 50,000. You're making money on 50,000. When you're buying a property, you're putting 50,000, but you're making money on the 500,000.
Exactly.
Right.
Exactly.
So yeah, that's a big deal. Okay, so let's move on to mortgage qualifications. So we talked about down payment and the different options that you have there. So there are a lot of creative ways to get down payment. So don't be discouraged. But let's talk about mortgage qualifications because that's the second most important thing. And I hear it all the time. Oh, I can't get qualified. I don't have the income. Blah blah blah. I hear it all the time, right?
I mean, I think you know this, right? The first thing is see if you get qualified, right?
Yeah.
And if you can't get qualified, what are the other options? Don't just give up, right?
Yeah.
I mean, one thing is to ask somebody to help you out. And that's something that's very often done. And we add somebody to the mortgage. From a legal perspective, I'm always interested in knowing this because that additional person that's not actually paying anything, it's not actually, they're just kind of there just to make sure and get approved by the bank.
Yeah.
They shouldn't actually be the owners of the home, right? Even though if they're on the mortgage, technically they should own part of the home. So there's ways legally that we protect the person. We end up putting them as 99% owners, 1% for the person that's helping out. And of course, we kind of have agreements between them to make sure that there's no conflict, right?
Yeah.
But that's a very common thing. Another really common thing is private financing, right? Private lending, which is basically, you have your institutional lenders, which are banks.
A lenders.
A lenders are banks.
That's what they're
okay.
called, yeah.
Then you have B lenders, which
Yeah.
are, institutions that lend money that are not interested in being on the corner and giving you an ATM machine. So they're not your TDs and RBCs. They're, different institutions, but they're still financial institutions. So those are B lenders. And then you have people, right? People have a lot of money that they want to lend out and make money on. Now, because it's an individual or a company that's not an institution and regulated and all that stuff, there's higher risk. There's higher risk, so there's higher percentage rates, but it's an option.
And I'm seeing a lot of people get into private lending in this market right now. They're seeing the opportunities.
Yeah.
But yeah, just be aware that it is higher interest, but it will be worth it if your property's appreciating like crazy, right?
Exactly.
And after a few years, you've made money, you refinance it with the lower interest rate, you pay back the private lender.
That's why I say, it's an option and you need to do your numbers.
Absolutely.
Very often, there will be on a joint venture, for example, where there's renovations or things to do, and the bank doesn't feel comfortable. Very often, when people want to go into these types of investments, they'll just do the numbers. They'll say, okay, well, we're going to pay 10 to 12% interest on this loan, which is quite high, especially given the market. But we're going to make, 25, 30, 35%. They already factor that into the expenses, right? And so it's an option. And not only that, it's an option that might give you comfort, okay? So maybe you're not sure whether you're going to qualify 100%. Maybe you'll squeeze by and get, a B lender. But, at least you can have it in your back pocket and say, to give you the comfort of going in on a deal, if you really want to get in on a deal, if you've done your math and you say, okay, well, I'm going to put an offer and I'm going to try to get a great mortgage, conventional bank, A lender, B lender maybe. But if not, there's always private lending options, and this is what I'm going to look at.
Yeah.
Right? Not that it's ideal for everybody all the time, but it's always good. Plan.
It's
know what
the
your options
last
are.
resort. It's one of the last resorts, but keep that in your back pocket because it might not be so bad. Like people, when they hear private lending, they get really nervous. But it doesn't have to be so bad, right? Just look at the long run. Look at ways that you could pay it back as quickly as possible, right? Just get into the market somehow, right? As best as you can without over leveraging yourself, right? You want to be able to make the payments.
I have to say, with private lending, you must have an end in sight.
Yes,
You must
absolutely.
be able
I agree
to,
with you. Yes.
after a year,
Yeah.
you have to be able to get out of that, because if you don't, it does become a little bit taxing in terms of the fees and the interest rates and whatnot. So that's why I say it's usually joint venture agreements. You'll often see that if needed, or you'll see it on a plan where I'm going to do this now just to get my foot in the door because I need to make the deal close, and I'm going to get out of it in a year.
Yeah.
And that's very typical. And we
Very
often see
typical.
people a year later get right out of those privates into a conventional mortgage, and then they're smooth sailing from there.
Well, that happened with one of my clients about a year ago. They couldn't, something happened. They couldn't get their mortgage. They ended up getting a private lending, but within a year, they were able to pay that money back. And now they're with an A lender, right? So sometimes things happen. We just have to open our minds and be creative, right? But it's important to work with the right professionals.
Well, this is the thing, right? Like, you want to work with professionals that can talk to you openly about all the different things available to you. You want to work with people that are creative, that have different views on what is opportunities
people,
available, network of people, right? And I think that's the most important thing. The more that you just absorb knowledge, the more confident you feel going into any deal, right? And the more that you feel that you can engage in the real estate market. It's a great market. There's a lot of people that, expand their financial portfolios. They create retirement plans out of real estate. Even if it's not 100% of their portfolio, it is typically a very, very large portion. So I encourage everybody to just start learning from now.
And I also encourage a lot of people, even if you're not ready right now to get into the market, speak to a mortgage broker that is a great financial advisor as well. Also a lawyer. And start planning. You may not be ready today, but they'll put you on the right path to be ready maybe next year or in 2 years or whatever, right? Don't just put it in the back of your mind and not even think about it. Like, just think about it and start preparing from today.
Yeah, 100%. Right? And scary things can be dealt with in contracts.
Yeah.
We can make agreements. That's what we do as lawyers. I know that sometimes think it's, you think you go to a lawyer after, things have gone bad. But the reality is the best time to go to a lawyer is the beginning, to say, okay, this is what we want to do. I want to make sure that I'm not going to harm them in any way. I want to make sure that we're not going to fight in any way, that we're all going to make money or whatever. How can we express that in writing?
Yeah.
And, that's our job, right? Okay, have you thought about this, this, and you leave with a sense of,
hope.
Hope. I mean, satisfaction, or at least like relief.
Yeah.
That, okay, you've touched on all bases. You know what could go wrong and how to tackle it, and whether it's a good opportunity or a good option.
Yeah,
right?
yeah,
So,
for sure.
Yeah.
Because also, like, a lot of people Google things and they get very nervous. There's a lot of misinformation on Google. Okay, just consult with your professionals. So the last thing is we kind of touched on this a little bit, but a moving target. Like, the market is a moving target, and you just can't keep up, right? Like, a lot of buyers just can't keep up, and the market demands certain things from you, such as you have to go in with no conditions. What are some of the conditions? Finance conditions, inspection conditions. Typically in a regular market or in a buyer's market, we would be able to put a condition of finance, which would give you usually 5 business days to consult with your mortgage broker to get that approval, and then 5 business days to do an inspection and make sure that structurally everything is okay, and you're aware of what repairs need to be done. Now, in a seller's market, in a crazy heated market that we're in right now, you really can't do that, because you're competing sometimes with 10 offers, sometimes 20 offers, and I've seen even 30, 40 offers, right? So how do you go about that? Because it's really scary. A lot of first-time buyers, they get very nervous about going in with no conditions, right?
Yeah.
So here are some of the kind of solutions I can give you. Number one, make sure your finances should be in order, whether you're in a seller's market or in a buyer's market. Yeah. Nobody should be, shopping for a house without knowing what they can afford. That's number one. Number two is you can always do a pre-inspection, either walkthrough or pre-inspection report before the offer date. There's generally an offer date for most of these properties. So if it really makes you nervous to go in with no conditions, I always say, and I've done this for so many of my clients, because I understand the fear of buying a property not even knowing if the roof is going to collapse,
Yeah.
But really, you could do a walkthrough. A lot of inspectors will do a quick 1 hour walkthrough. Just tell you structurally if everything is good and you don't have anything major to worry about, right?
Yeah. Yeah. I mean, you know, it's always important to know that any investment is risky.
Yeah.
You know, I mean, the level of risk is different. And so I get this all the time because people are afraid of going into firm contracts. And that's why my first thing is educate yourself and just know what your options are. Work with a great team. Know that, okay, if things don't happen this way, what are my other options? And have a plan or maybe just a knowledge of where you would go from there. Okay. You're never going to fully, I mean, you know, there are so many deals that we have where, hey, the washing machine breaks the day after, you know, and it sucks. But even if you were living on your own and the washing machine broke, it would suck, right? I mean, like there are things
also, you
that happen.
probably made money on your house before you've even moved
Exactly,
in.
exactly.
Right?
And you know what? The reality is that once you get in your foot in the door and you buy the house and you become a property owner, like that asset is on your financial statement.
Absolutely.
And people will be more. It'll be much easier to get money lent to you because you have that equity, because you have that asset, than not having anything at all.
Yeah.
So like, God forbid, you know, you go into a deal and something actually happens and you didn't catch it or whatever, right? Once you're the owner of a property, then you'll find it easier to find other financial solutions, right? Like credit, different things available to you. Even if, of course, nobody wants to go into serious debt or whatever. There are options available to you, right? And so I think the point is, you know, getting in the door is number one, if that's what you're looking to do.
Yeah. And the last thing I do want to add to this is about the inspection thing. So again, I know it's really scary, but you know, the worst I've seen personally is $25,000, $30,000 repairs. There's probably more. There's probably worse situations, but it's not very often. And $25,000, $30,000. Remember earlier I mentioned, if a house sells for $800 today, tomorrow it's not $800 anymore. Not in this market. It's $820 now. It's $830 now. So sometimes it's kind of worth taking it, right? It's not the best case scenario, but do a pre-inspection. Do a pre-inspection walkthrough if you're really, really that nervous. Sometimes new homes, like if they're less than 1 year old, they have carry-on warranty, which is, you know, which you're kind of protected with certain repairs. So it's a tough one, that one, but as long as you're prepared and you're on top of it and you're looking at properties as soon as they hit the market, you have enough time to do your due diligence. Yeah. Right?
Yeah. I mean, there's a lot of things that you can find on a walkthrough, and you know, I think you're not going to be able to predict absolutely everything.
You Even an inspector won't be able to.
Rare. Yeah. It's so rare. And if you're going into a home that really looks like it's falling apart, I mean, you kind of got to know what you're going into. Yeah, if that's what you're going into, then your intention should be to maybe fix it to some capacity, right? Yeah. So again, it's just about knowing. And if you're really that nervous, you can always go for a condo. Yeah. Right? Another thing we didn't touch on is the idea of moving outside of certain areas to purchase, you know, breaking into the market in a different way. And sometimes people are really focused on buying a property which they are going to live in.
Oh, yeah.
You know,
this is a big deal.
That's a huge deal, right? And because I get the whole, you know, primary residences have tax benefits, okay? But you can have a primary residence. You can have a property designated as your primary residence for the purposes of capital gains, right? But you don't actually live there. Yeah. As long as you don't have another one that's designated as your primary residence. So you could buy a property and still live at mom's house, right? And designate it as your primary residence. I believe it's 4 years. I always say ask an accountant, okay? But I believe it's 4 years. And then in 4 years, when the property value has gone up, right, now you've made money and you can sell it, you can refinance it, you know, you could choose to live in it. But there is that other option.
And people are really scared of taxes. So honestly, if you're trying to be an investor, you're just going to have to talk to an accountant and find different ways to reduce your taxes, but you're going to have to pay taxes. Don't be afraid of paying taxes, right?
It's a business expense.
Point, you will just have to pay it. Don't let taxes stop you from becoming a real estate investor or becoming a homeowner, right? Just find different ways to reduce it, but you were gonna have to pay some taxes.
I mean, the reality is that if you're paying taxes, you're making money.
Yeah.
So the only time you pay taxes is when you make money.
Yeah.
And you just calculate it as a business expense. People have the habit of, thinking that they are owed more than that they're owed.
Yeah.
So if you just calculate it from the get-go, you calculate your tax expense, which is what really most savvy investors do. It's just a part of the game.
Back to what you were saying about if you can't get into a house, townhouse, freehold, detached, whatever, get into the condo. So I actually did a survey, and it's shockingly almost half people, about 45% of people said that if they couldn't get qualified for a mortgage for a freehold, they actually wouldn't buy a condo just to get into the market. And that's unfortunate to hear, because if you really, really want to get into the market, you just have to be flexible, because Toronto is not the type of market where you're going to save up. Mm-hmm. It's moving too fast. It's moving faster than you can save. Just get into the market, find a renter, you'll figure it all out. I promise you. So with that being said, I think we can kind of conclude this podcast. Did you want to add anything?
No, I think you're right, and I think we're on the same page. I think with most of these things, right? I mean, the only thing is sometimes you got to think about your decision as, is it emotionally motivated, or is it business and prosperity motivated? And business prosperity and a long-term plan sometimes requires being creative and not saying, well, I only want to move to a freehold with a pool, right?
Yeah. And I think even emotional, like if you're buying it as an end user, sometimes you kind of have to think, okay, if I can't make it work, I have to kind of make it work in a different way, right?
Yeah.
Sometimes people have the intention of being an end user, and they realize that's going to be really difficult because some people have families. Mm-hmm. So you just have to find different ways to get into the market. It will be even better for your family in the future.
Most definitely. Yeah. And you know what? It's the beginning of an estate plan. We say this all the time, because it's the biggest asset that most people buy. And it's usually the thing that people want to leave to their kids. And they want to leave to, they rely on it for their generations to come. So, from my perspective, I think it's super important to start planning for it, and to, get ahead of yourself financially with your financial education, and start working with a great team and acquire that team. The earlier, the better, because, the earlier you have a team on board and you have a plan, like a financial plan for your future, of which real estate is usually a really big chunk, if not, a large chunk. The earlier that you get into it, the better you are from every perspective.
Yeah, definitely. It's a wonderful investment and a retirement plan. So if you guys have any questions about you want to know more information about mortgage qualifications or down payment or estate planning or anything on the legal side, you can reach out to us. We'll leave Emma's information below, and you can also call us, send us a message, and one of us will be able to reach out to you. So Emma, thank you so much for joining us today. We're gonna have more of Emma in the future. We work with her on all our files, and she's been amazing to work with. She has a great team, and it's always a pleasure. So thank you so much.
Well, thank you for having me. It's always great to have you.
Thank you. If you guys enjoyed this information and you want to know more information, or you think somebody could benefit from this, please share it, comment below, click that like button. It'll really help us, and we appreciate you guys watching. And we'll see you in the next one.